I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 7, 2023. I'm going to give you the charts and data for the market for the past week and for the past year or so. So I'll begin with a dashboard, and this shows the 6 major equity indexes and the long-term government bond. And these are represented by exchange-traded funds, ETFs. So at the top is the NASDAQ 100 represented by QQQ. And you can see I rank them based on the year-to-date performance, which is illustrated in the yellow box, sort of in the center of the page. So you can see the NASDAQ 100 has gained 33% year-to-date, and the S&P 500 gained 11%. And then EFA, which is the developed foreign markets, 10%. Then it drops off down to the Russell 2000 and the emerging markets, both of which gained 4%, and the long-term government bond gained 2%, and the Dow Industrials gained 2%. To the right of that, you can see there are 4 columns of dots represented by the 20, 50, 100, and 200-day moving averages, and all of them are above these moving averages, except the long-term government bonds, which is below all 4 of the moving averages. So equities, very strong. Bonds, fixed income, weak since the beginning of the year. When I take the S&P 500 and break it into its 11 sectors, it's a very different picture. So keep in mind, this is the S&P 500. We just looked at the chart that showed it's up 11% year to date, and that it is above all 4 of its moving averages. But when we tear it apart and look at it, we can see what are those sectors inside of the S&P 500, what are they saying? Well, when you look at the top 3 of them, this is measured from the top down, you see the year-to-date technology up 34%, consumer discretionary up 21%. Then it drops off, look at it. It drops off to 2% for industrials and 1% for basic materials. Everything else is negative year to date. Even though the S&P 500 is up 11%, look at the 9 sectors that worked to pull down that number, and the 2 sectors that worked to pull it up. So it is still a market that is mostly driven by technology and consumer discretionary, and the rest of the market is fairly weak or very weak. And so what was strong last year is weak this year, and vice versa. So when you think of, oh, the market is strong, and I do think that, the market is strong in general, there are parts of the market that are still very weak. When I put this on, this is an 18-month chart showing the weekly moves in the S&P 500. You can see the first part of the chart where it's mostly down. Beginning on October, you can see it's mostly up. And at the very end of it, you can see the last few weeks that have definitely been up. And that's the direction of the S&P 500. But keep in mind what I just showed you, there are most of the sectors, the vast majority of the sectors are negative. And so this is being pulled up by a couple of sectors, and especially a handful of technology stocks. Growth versus value. Inside the S&P 500, the stocks that are in there fall into one of two camps. They're either growth-oriented or they're value-oriented. And the growth stocks continue to move up relative to the value stocks. So you can see from the beginning of 2023 how much they have moved up. They're up above their 20-period moving average, and they are still influencing the market in an upward direction. The S&P 500, represented by SPY, is relative to small cap. Okay, S&P 500 is large cap. That's the largest 500 stocks in the stock market. Small cap is the Russell 2000, which represents the small companies in the market. When those are put on a relative strength chart, the S&P 500, large cap as numerator, small cap denominator, you can see it is still, even though it came down this last week, you can still see that there is strength in large cap versus small cap. Long-term government bonds. You remember the dashboard that the government bonds are below. The ETF is below its 20, 50, 100, 200-day moving averages. This is why. It is basically going sideways and maybe even slightly negative relative to the rest of the market when viewed from, let's say, November, December of last year to present. It's negative. So what's the implication of this is that portfolios, traditional portfolios, include a portion in stocks and a portion in bonds. That's common. It's sometimes called 60-40, 60% equities, 40% bonds. And this is weighting down the return. Most portfolios are not in technology. They're in the S&P 500 or something similar to that. And so they're up some this year, but bonds are not. Bonds are negative, or at least the long-term government bond is negative. So the traditional portfolios are not up that much this year because of the heavy weighting that bonds have to bring them down. So, and last year you can see what happened in the first part of the chart, how far down bonds came, and in a number of cases they were down further than stocks. So a stock bond portfolio was down a lot. Bonds didn't do much to help you counter that equity risk, and in some cases made it worse. So, and now they are a weight holding back the gains that are occurring in some equities. And that's the reason that I don't use traditional portfolio allocation. The US dollar, represented by the ETF UUP, has went up a long ways, and then it has come down. Lately, it has been going up at the very end of the chart, but still from about October to present, it is still in a trend that is still negative. Gold has been in an upward direction, moving up, generally speaking, since about November. It has gone up and down. Recently, it came down some. It was kind of flat this last week, but generally speaking, it's moving in an upward direction. Silver, same thing, except with silver, the moves up and the moves down are more dramatic. So you still see that upward direction, but you see when it comes down harder. When it goes up further. So, but generally, most of the time, it's correlated with gold. When I put those on a relative strength chart, silver is a numerator, gold is a denominator, it kind of goes up and down a lot. So I didn't put any arrows on here because there is really not a specific pattern other than just up and down a lot. But you can see recently, you know, it's gone down, it's gone up, it's gone down. Now it's trying to go back up. You know, when it goes up, it favors silver. When it goes down, it favors gold. Bitcoin has been, generally speaking, in an upward trajectory since the beginning of 2023. It has had some pullbacks, and it's had a couple of those, and is now in a pullback mode. But generally speaking, from the beginning of January until present, there had been some nice gains in Bitcoin. Volatility index. Now, this is interesting because this shows strength in the market, because when it goes down, when volatility goes down, it favors equities going up and vice versa. So you can see the drop at the very end of the chart, the far right chart end of the chart is down. It's down below 15. It's down around 14. Back in October, it was as high as 32. 32 down to 14. That's a long drop. But it shows that there is strength that is favoring equities. And while there are negatives with equities, I've covered those where they are not as strong as they could be, and in some cases they're weak. Generally speaking, the market is saying there is reduced volatility in the market. Asbury Research provides 6 metrics. Last week, there were 5 out of 6 that were positive. The last one, market breadth, was negative. Why? Because the market was mostly being propped up with about 8 stocks, and the rest of the market was fairly negative. So the market breadth was not there. The market was going, part of the market was going up, part of the market was going down. As of, particularly because of Thursday and Friday, and this changed actually on Friday, the last one, market breadth, turned positive because, again, there was market breadth on Friday. Is that going to continue? I can't tell you that, but I can say that right now, all 6 of their indicators are positive. When you look at the relative, the cross-asset relative performance of different assets, one versus the other, I'll cover that. So stocks are more favored than bonds, obviously. You can tell that from the data that I presented. High beta, higher volatility type stocks are more in favor than low volatility stocks, like NASDAQ versus Dow. Large cap, more in favor than small cap. Broad market, S&P 500 versus the Dow, the blue chips, the broad market is more in favor. Technology is more in favor than the broad market, the S&P 500. So they kind of go in that order. Technology, broad market S&P, and the blue chips, Dow, in descending order. Growth stocks, more index more favored than value. All of these we've covered. U.S. more favored than the emerging markets and the developed markets, both in the last week, the last month, and the last quarter. And in the bond category, high yield is performing better than corporate, than high quality. So U.S. versus the world, I look for green boxes. This shows enough strength to say it's positive, strongly positive. Many of these show the U.S., but the U.S. barely is better than these other countries or regions. There are only 2 that have enough strength to say they get a green box, and that is Taiwan and India, stronger than the U.S., both in the last week, the last month, the last quarter. Jumping over to gold, gold is up slightly, 0.2% from the week before. Silver is up 1.3% than the week before, so more strength in silver slightly. The gold-silver ratio is still at about 83-1, which favors silver. Silver is a better buy at this ratio. a monster box of silver, 500 rounds of bullion, which is just generic silver. It's not silver eagle, for example. And a monster box has moved up a little bit because silver moved up a little bit this week. Is now $14,040. The markup over spot is $4.40, and the cost per round, including the markup, in a monster box is $28.08, and in a tube of 20 is $28.58, so about 50 cents more. This is not true for all retailers. This is from my son Preston, and I get this information from him. But it gives you a benchmark that you can look at prices and know what brick and mortar retailer would sell this for. I do favor using local retailers and brick and mortar for sure. And I do favor buying the physical asset of silver, or gold for that matter, the physical asset versus the paper exchange traded fund. When the market goes up, this year might be an example. Those in the market that are thinking, maybe not thinking as positively, or keep thinking, this is the top, no, this is the top, no, this is the top, maybe meaning, now I'm going to get out, or now I'm going to short the market because this is the top. When you go to, I think this, I think that, not based on any kind of technical indicators, you're left with the fact oftentimes that the market keeps going up. And if you get out of the market too soon, or you short the market too soon, it can be expensive for you. You want to participate in the market when it's going up and not try to expect, even though you have an opinion, not try to use that for your investing philosophy, because as you can see from this, trying to pick the top, you can be wrong. And certainly I can be wrong. That's why I don't try to use my gut feel to say this is the top or that is the top. So we have had a good run. It seems to be continuing, especially in the growth sector. But we don't know when it's going to end. You know, at some point it will. But right now, money is coming into the market, and it is I want to give you a positive view of the market at this point. Thank you for watching. If you have questions or comments, leave them in the comment section below.